Thank you so much for having me, and hopefully you can hear me okay. We're going to go ahead and get started. We do have a lot of information to cover. I do want to thank you, first of all, for joining us. We know that your time is very precious, especially during these very busy times. And so we hope that you find this information valuable to you and that it will help you do more business. So let's see, here we go. So introduction about me, my name is David Mendez. I'm an affordable lending manager with Freddie Mac. And in my role, I provide outreach and support to both real estate agents and loan officers. And specifically, I serve a niche in that I work with those agents and loan officers who work with housing finance agencies and do housing finance agency business. This particular presentation is going to cover a broad scope of different products, but in my normal role, I do specifically work with loan officers and real estate agents who work with our HFAs. So a little bit about Freddie Mac. Not everyone knows about what we do. They've probably heard the name, but not exactly sure what our role is. So first of all, we were chartered by Congress in 1970. We operate in the secondary market. We just recently celebrated our 50th year anniversary. But what operating in the secondary market means is that we don't originate any loans. We purchase loans from lenders, and then we bundle those loans that have similar characteristics and we sell them on the secondary market so that the lenders then get repaid for those loans and they're able to continue to make more loans. So that's what we call liquidity. We are mission driven. Our mission is to promote liquidity, stability, and affordability in housing nationwide in all economic conditions. And it's important to mention that in all economic conditions. So we are here, again, promoting liquidity, stability, and affordability when the economy is strong, as well as when the economy is not so strong. And so being here, being able to be relied upon really helps provide that stability that you're looking for, and really helps, especially times like these when there's a lot of things going on, but the housing market is very strong. We're also community, we have a community mission, and that is to stabilize communities, to prevent foreclosures, to expand credit responsibly, to educate future home buyers and counsel homeowners, and then support affordable rental housing. And we also have three main business lines. So the business line that I work in is single family, 1 to 4 unit for sale properties. And then we also have a multifamily division that focuses on 5+ unit for rent properties, and then a capital markets division as well. So we recognize that it takes many hands to make home possible. Partnership and collaboration across the affordable ecosystem are critical to drive both business opportunities and make the dream of home a reality for families. As you can see in this little printout, we have local governments, loan officers, real estate professionals, and this is just a few of the folks that are responsible for making home possible in every single transaction. There's a lot of moving parts, and we want you to know that we're here to collaborate with you and that we are all for home. So when a lot of people think about Freddie Mac, they think about mortgage products. And while it's true, we do have offerings that meet borrower needs now and in the future, to include low down payment options, energy efficient properties, factory built housing, etc. But we also have other pillars. So education, for instance, we have events, training, financial literacy curricula to help better prepare borrowers for home ownership and to promote responsible and sustainable behaviors. And I'll be talking about our CreditSmart curriculum in this presentation. We also have business solutions, and I'll be talking about some of the great, innovative, cutting edge technology that we have available to help make your job easier and to help make the process for your customers a lot more seamless. And then we also have insights. So insights through research studies, through thought leadership, through speaking opportunities like I'm here today, expert contributions and data to position our clients and partners for success. So what's going on in the housing market? What is the state of the housing market? So every quarter we update these slides, and the market has been changing on such a fast pace that even when we produce these slides a month later, they can be outdated. So a lot has changed even since this most recent slide was created. And we'll go into some of the more accurate, up-to-date information in a moment. But at the macroeconomy level, as large swaths of the U.S. economy shut down to battle COVID-19 pandemic, it faces the greatest challenge in over a decade. Since March of 2020, unemployment has reached historic levels and overall spending has declined. And back in March, when I was doing this presentation, prior to COVID, unemployment was at the lowest rate it has ever been in history. And, just a few days later, it spiked to, one of the highest ever in history. So a lot can change very quickly. But still, there is optimism for an economic rebound as states begin to open businesses. Reduced economic growth will keep inflation in check. In housing, housing inventory continues to be scarce, especially now. We see that more and more people are looking to purchase housing. In some cases, as a result of COVID, they want more space, they need more space. We see that families are working from home, they need that office space, they want a separate space to work from their normal dwelling. Home sales and new starts have declined. Home sales only because inventory has been so scarce. The government and Freddie Mac's response to COVID-19 will help to offer forbearance to homeowners and pause evictions of some homeowners and renters. And then the fiscal stimulus provided by the CARES Act did help mute the impact that the economic shock had on housing prices. And we'll see now that there has been a lot of change. Mortgage rates have been declining. In fact, here at Freddie Mac, we publish a weekly survey every Friday of the U.S. weekly average interest rate. And last Friday, October 15th, we recorded a new all-time low. We've had several all-time lows in the last several months, but last Friday was the new all-time lowest interest rate for the 30-year fixed rate mortgage at 2.81%, which is, amazing. If you can see, I'm not sure how big your screens are, but back in the 80s, they peaked at over 18%. The average interest rate was peaked at over 18%. Now, again, back in October 15th, the lowest interest rate ever recorded by us at 2.81%. What's interesting is the 15-year fixed rate mortgage, or the 5/1 ARM, is actually trending higher than the 30-year fixed rate. And that's what they call the inverted yield curve, where long-term interest rates are actually lower than short-term interest rates. So investors are somewhat skeptical of what short-term variability may be, but they're pretty confident in the long term that things will be just fine. And so that's when you see that inverted yield curve where interest rates on the 30-year fix are lower than the 5/1 ARM. This next slide is really amazing. As you can see, home price performance by state, year-over-year growth from August 2019 to August 2020. In Arizona, year-over-year growth is 11%. So that's way above the national average. You can see the national average in the United States is 6.7%. In Arizona, growth is 11%. Utah, 11%. Idaho is 12%. You can see some of these, higher growth rates surrounding California. So what we know is there are a lot of folks that are moving out of California and heading into more affordable areas like Arizona, like Utah, Idaho. So just very interesting. And it's also important when we think about, this growth rate, when we're talking about conventional loans, and I'll get into that later on in this presentation. But as you may know, conventional loans require PMI insurance if the LTV is 80% or greater. But when you're appreciating at 11% year over year, in just 2 years, you can go from a 97% LTV down below 80% LTV and get that PMI removed. So it's something to think about for your customers when they're thinking about what's the best product for them. Quite often, they may think about going with the FHA loan. On FHA loans, that mortgage insurance stays on for the life of the loan. When you're going conventional, that mortgage insurance can be removed once they've been in the home for 2 years and once that LTV is 80% or lower. So, you got to think about, what is best for your client short-term and long-term. And a lot of times going conventional may be the better way to go because they can get rid of that PMI insurance. And we'll talk about that a little bit later in this presentation. But just amazing growth throughout the country, and especially in areas like Arizona, one of the highest year-over-year growth in the nation at 11%. Household demographics. So there have been a lot of household formations. In 2019, there were 1.2 million new households formed, and that's almost double what it was back in 2013 at 653,000. So there's a lot more new households being formed, and they're looking for housing. They're becoming that age right now where they want to move out, where they want to purchase a home for their families, and those household formations continue to grow. There's still 25% of millennials that are living with their parents. And, when I think of millennials, I incorrectly think, college kids, or I shouldn't say kids, but young college adults. But it might be surprising for you to know that the oldest millennial just turned 39 years old. So again, when you're thinking about millennials, you have to really think about, okay, who are millennials? They're now as old as 39 years old. So millennial households, in 2015, there were 16 million millennial households formed. By 2035, we project almost 50 million millennial households. So these millennials, they probably are already your current customers, and they are going to continue to be your customers into the future. So when you're thinking about how am I marketing to these millennials, what is their preferred method of communication? A lot of them prefer text over a phone call. When you're marketing to them, you might find yourself marketing to them, via Facebook or Instagram. And, some of these younger millennials or Gen Ys, now they're into, TikTok and Snapchat. And so you have to really think about and be strategic about how am I communicating to these demographics and how am I advertising to these demographics. Minority share of households. So households growth projected between 2015 and 2025, 75% of that household growth will be among minorities. So again, something to think about when you're thinking about, who are my future customers? Your future customers are going to be millennials, and a lot of them are going to be minorities. So again, it's important to think about, how you are communicating with them, how are you marketing to those different demographics. And then it's important not to forget about households age 65 and older. So we project the growth between 2015 and 2025, 31 million households aged 65 and older. And there's a lot of things changing. In the past, we would have expected many of these age 65 and older to sell and downsize. And we do find a lot more of these households age 65 and older staying in place. And another anomaly we find is that these households are living longer. And that longer lifespan is actually, reducing the available inventory in the market. So that's certainly a challenge as we think about available inventory and affordable inventory out there in the market. But there are some things that you can do to help find that available inventory, and we'll talk about that through this presentation as well. First-time home buyers. So of all the home buyers in the United States, 33% were first-time home buyers, and that's as of 2018, the most recent information that we have from NAR's 2019 forecast. So that was a decrease from 34% in 2017, and that was a decrease from 35% in 2016. So we see the share of first-time home buyers decreasing over time. It's trending in the wrong direction, and a lot of that has to do with just affordability, affordable inventory that's out there. The median age of the first-time home buyer is 33, and the median income is $75,000. And again, we're talking national average here. That number may be different in your geography, but as a national average, that's where we are. 78% of those first-time home buyers get their down payment from savings. And that's important to note as well, because a lot of them, there's misunderstandings that they think they need 20% down, when in reality, there are programs out there that require as little as 3% down. But it's really up to us to make sure that, you know, those first-time home buyers are aware that there are programs that are available as little as 3% down. And you might get pushback. You know, a lot of them may say, yeah, but I want to save for the 20% because I don't want to have to pay that PMI. Well, we just saw that with the year-over-year growth of 11%, in as little as 2 years, they'll be out of that PMI. So again, we need to, you know, make sure that we are educating those potential borrowers so that they're not self-disqualifying themselves out. And that's very common that, you know, because they read something on the internet, they automatically self-disqualify themselves when in reality, they could be homeowners right now. 24% of first-time home buyers get their down payment from gifts from friends or relatives. 26% used FHA loans, 12% used VA loans. The typical first-time home buyer loan is 1,600 square feet and costs $203,700. Again, that may differ slightly from your geography. And first-time home buyers do plan to stay in their home for 10 years. On the right side, we see this pie chart. Married couples represent the majority of first-time home buyers at 54%. Unmarried couples are 16%. Single males are 10%, but single females are 18%, almost double that of single males. And so again, when you're thinking about who are my current customers and who are my future customers, who are the folks that I have been working with, you probably have worked with quite a few single female millennial minorities. You know, again, it's important to start thinking about, you know, who those demographics are now and into the future. Homeownership opportunities. So there are 37 million what we call mortgage ready opportunities. So what is mortgage ready? So we define mortgage ready as someone who has a FICO score of greater than 620 with a debt to income ratio of less than 25%, who have not had a foreclosure or a bankruptcy in the last 84 months, or no severe delinquencies in the past 12 months. So based on that definition, we estimate there are 37 million mortgage ready folks right now. 24 million are millennials, 4.3 are Asians, 7.8 are Hispanics, and 2.9 million are African Americans. But as I mentioned before, a lot of these mortgage ready individuals are self-disqualifying themselves out because they have read information on the internet, but they really don't understand it, and they really need professionals like those of you who are on this call today to help explain to them, you know, give them an overall picture. So this is a very telling slide as well. Time to save for that mortgage ready population that we just talked about. So just to save 3%, if we look in this column here, on average, it takes non-Hispanic whites 2.2 years to save that 3% down. It takes Hispanics 3.7 years to save It takes Hispanics 3.7 years to save that 3% down, Asians 3.5, and African Americans 2.3 years. So they're going to be saving anywhere from 2 to 3 years just for that 3% down payment. But again, a lot of them think they have to save 20% in order to buy a home. So if we take a look over at this 20% column, I think this slide alone can really help move a lot of those borrowers off the fence and get them to take action when they realize in order to save 20% among that mortgage ready population that we talked about, non-Hispanic whites, it'll take them 14.4 years to save for that 20% down payment. African Americans, 15.4. And then what we see in the Hispanic and Asian population, it takes over 20 years, 24.5 for Hispanics, 23.5 for Asians to save for that 20% down. And that's because a lot of Hispanic and Asians are in more concentrated high cost areas along the coast in California, Florida, and New York that are much more higher cost. And so therefore, it's going to take them even longer to save that 20% down. So if you can put that, something like this screen, something like this slide in front of them and help them realize how long it's really going to take them to save for that 20%, it really may help make them take action and move forward and quit self-disqualifying themselves out of purchasing a home now. So those are the averages. Over here, we see time to save for 3% down by county, and this is even more amazing. If you look on the West Coast in blue, it can take 5 to 10 years just to save 3%. If you look over here in this red in the Silicon Valley and San Francisco, it can take more than 10 years just to save for that 3% down payment. Again, there are parts of Florida and New York that take that long to save for that 3%. Even in Arizona, where it's considered more affordable, we see the green 2 to 5 years, and then there are parts where it can take 1 to 2 years to save for that 3% down payment. So again, it's up to us to make sure that we're educating our customers. So how do they come up with that 3% down? So we saw that most of them are saving for their down payment, but there are housing finance agencies that can provide both down payment and closing costs to those borrowers who are considered low to moderate income. And so we have programs like our HFA Advantage Mortgage that's available for 1-unit primary residence. It's for purchase and for no cash out refis, and it will allow them to go to a 97% LTV and 105% TLTV, or total loan to value. And so what that 105 means is that you can layer available down payment assistance programs that are offered by, for instance, Arizona HFA. There are programs in Phoenix, Maricopa, Pima, Tucson, programs that will provide either the down payment or the closing costs, or in some cases, both the down payment and the closing costs, effectively allowing your customer to purchase a home for little to no money down out of their own pocket. They can literally purchase a home for almost no money out of pocket. These programs are amazing, and they are out there available for you to use. Flexible funding for down payment options and closing costs. This program, the HFA Advantage Mortgage, requires no reserves. So we know that a lot of these borrowers are cash strapped. They make a good income, but it's hard to save because the cost of living is so high. So in these cases, we require no reserves, again, for those borrowers who are at 80% or less of the area median income. The HFA establishes the income limits. This program is available not only to first-time home buyers, but also repeat buyers, and like I mentioned, borrowers who are seeking no cash out refinances. We require them to be underwritten by LPA, our loan product advisor underwriting system, and then also flexible mortgage insurance options. So I already mentioned that PMI that can go away in as little as 2 years, especially when home prices are appreciating as they are. But when you're using the HFA Advantage Mortgage, we have reduced what we call charter level mortgage insurance, which is roughly half of the coverage requirement of standard mortgage insurance on a standard conventional loan. So not only do they have little to no money required for the down payment, no reserves, but the mortgage insurance is going to be reduced as well. So, you know, this is a great alternative to FHA and a great opportunity for those mortgage ready borrowers to be able to purchase a home with little to no money out of their own pocket. We also have our Home Possible mortgage. That too is a low down payment program that requires as little as 3% down. And again, that one also can go up to 105% of the total loan to value when they're using an affordable second. Flexible sources of funds as well for down payment. Cancelable mortgage insurance, as we mentioned, once that LTV is less than 80%. It is also not limited to first-time home buyers. And this one does allow for manufactured homes as well. There's no minimum borrower contribution. We also allow for non-traditional credit and improve sustainability with home buyer education that helps the borrowers prepare for the responsibilities of home ownership at no cost to the borrower. So we have a CreditSmart curriculum, which I'll talk about, which educates your borrower, prepares that customer so that they know what to do when the water heater breaks. They know what to do when those unexpected things happen. It helps them to budget. And we see that customers who do get home buyer education perform much better in the long run than those who don't. So we also have our Home One mortgage. So the last two programs were limited in most cases to borrowers who are at 80% of the area median income or less. Our Home One program is available to income of all levels, but still allows them to only come in with a 3% down payment. So we have folks who, make substantial income, over $200,000 in many cases. But even then, because of the high cost of living, it's difficult for them to save for that 3% down payment. So our Home One mortgage solution allows borrowers of any income level to acquire a conventional loan. Again, that conventional loan that has the PMI that can be removed after 2 years, with as little as 3% down. There's no geographic or income limitations. So these products allow you to find solutions for all of your borrowers, whether they're 80% or less of the area median income, or whether they have a strong income but can't come up with that 3% for the down payment. So we're also delivering on high needs products. There's a lot of challenges: aging housing stock, wide gap between affordable housing supply and demand, growing number of households looking for more affordable home ownership options, a rising number of people age 55 choosing to downsize and or age in place, and then increasing frequency and intensity of natural disasters. So we're also seeing that, and that's a big one to talk about, these increased frequency and intensity of natural disasters. I live in Southern California in a great city called Burbank, part of Los Angeles County. But what we've seen even in my surrounding areas is the intensity and the frequencies of the fires that we've been experiencing is just unbelievable. And so there are products out there that are available to help address those needs. And we're going to talk about some of them. So our first one, CHOICERenovation, is financing for renovation and repairs, including home resiliency. We have Green Choice Home Mortgages, financing for energy and water efficiency home improvements. And this one is important to mention. So, a lot of times when your customer's thinking about the payment, they're only thinking interest rate. They're only thinking that P&I or PITI payment, principal, interest, taxes, and insurance. But they're not factoring in the cost of some of the, the bills. So, with our energy efficient, water efficiency home programs, it can help reduce the cost of home ownership by reducing that electric charge, by reducing that water charge, by making that home more efficient. We know in Arizona, it can get quite warm, even hot. So a lot of times you're running that AC almost year round. But by having, energy efficient windows, energy efficient siding, it can really help, insulate the home and lower the cost of maintaining that home and keeping that home cool or warm. Manufactured housing, including Home Choice. So we offer financing for factory-built HUD code homes affixed to permanent foundations and titled as real property. There's a stigma that comes with manufactured housing. A lot of times, when people think about manufactured housing, they just think about, double wides in a manufactured housing park. but things have changed substantially over the last few years. And there's some great products out there, including our Choice Home product that, the homes you would not know that it's a manufactured home. And we're going to talk about that a little bit in the next few slides. And then shared equity home ownership. So financing for homes with lasting affordability administered by, not-for-profits or state local governments where they share in the equity. So the borrower can't come up with a down payment. That not-for-profit or state or local government will share in that equity. And then, as it appreciates, that not-for-profit or local government will get a piece of that equity growth, but allows the borrower to become a homeowner and also take advantage of some of that equity growth as well. So we're meeting the evolving needs with Choice Renovation. It finances a broader range of renovations. It allows renovation costs of up to or less than 75% of the appraised as completed property value. It allows renovations to rebuild homes to recover from damage caused by natural disasters and or improve a home's resilience to future events. It closes in a single transaction with a home purchase or refinance, and it allows for up to 6 months principal, interest, taxes, and insurance. And so I'm going to get into this a little bit deeper because this is one that you can really use to help uncover additional inventory for your borrowers. When a lot of families, they're looking for that traditional 3-bedroom, 2-bathroom home, and they're not quite looking at the 2-2s or the 2-1s or even the 1-1s because, those don't meet their family needs. But these programs, this renovation program, would allow you to buy a 2-1 and convert it into a 3-2 using this Choice Renovation program. And we'll take a look at how that works in a moment. But we also realize that while they're doing these modifications to the home, while they're upgrading the home, they still need a place to live. So they may have to pay rent somewhere else while their home is being upgraded. And so we allow them to have up to 6 months financed into the home while they're waiting for that home to be ready for them to move in. It's a fantastic program. It allows you to finance a wide range of home repairs. Proceeds used to finance renovations to an existing dwelling. So it's not going to allow you to build a new home, but it will allow you to convert that 2-1 into a 3-2. The proceeds may not be used to raise an existing structure and build a new dwelling or for personal property, but it does allow for new appliances. And we're just going to take an example. We're taking a look at an example here. In this case, the property sales price was $75,000. So this was a fixer-upper. It was a 2-1. They really needed a 3-2, but the market was so competitive, they couldn't find what they were looking for. So they bought a 2-1 and they spent $180,000 upgrading that home. So the total acquisition cost was $255,000. The as completed appraised value was $250,000. So the borrower did have to come in with $5,000 out of pocket to make up the difference. And the maximum allowable renovation costs were $187,500. The maximum loan amount was $242,500. The borrower contribution was $5,000 plus a 3% down payment, $7,500. Well, what this did is it allowed that borrower to buy that 2-1, spend $187,500 to renovate it, to turn it into a 3-2, to buy new appliances. And now they have what's practically a brand new home, completely renovated, and they had little to no competition in making an offer on that property because people weren't looking at those 2-1s or those 1-2s or 1-1s even. People are out there competing for the 3-2s. So this does allow you to open up more inventory in a way that, some folks really aren't thinking about. And in the end, that product was a completely renovated, beautiful home that they were able to purchase. So this is a great opportunity for you to, open up some of that inventory to some of your families who are looking for that more traditional 3-2. And then, as I mentioned, our Choice Home product, creating parity with site-built homes with exterior features. So in this picture, you see this is one of our Choice Home products. And if you were driving by or walking by, you would not know that this is a manufactured home. There are certain requirements, so it must include one of these design pairings. So dormers, which are these sort of peaks that pop out of the property, and attached or detached carport, or dormers and a covered porch, or a covered porch and or attached detached garage. Then siding must be any of the following materials: vinyl, fiber, cement, stucco, engineered wood, etc. But what you get here is a beautiful home that is significantly lower in cost than if you were to buy a site-built or stick-built home. These are, just wonderful opportunities for borrowers to purchase a home that they might not otherwise have qualified for. Taking a look at the inside, we require that they have energy efficiencies, such as a programmable thermostat. We have insulation minimums, and we require low E windows. We require 1,000 feet or greater gross living space in multiple sections. And then we require it to be drywalled throughout the interior of the property. But again, this is a great opportunity to be able to purchase a beautiful home for your customers at a significantly less cost than you would buy a site-built or stick-built home. And anecdotally, what we've seen is, in Florida, we've seen where, natural disasters through hurricanes, we've seen, certain areas where the site-built stick homes were literally blown away, and the only thing left standing were the manufactured homes because they were built to such a high spec level. So again, something to think about as an opportunity to open up more inventory for your customers. So talking about Freddie Mac technology, and I'm going to pause just to take a quick time check. Okay, we're doing good. So Loan Product Advisor, AIM, Asset and Income Modeler. So I realize I'm speaking to real estate agents right now. So, usually you're not the one that's involved, and sometimes you are involved in, collecting those documents that they need to get that approval. Through our AIM technology, a lot of times we're able to get their income and their assets online through technology, through directly looking at their bank, through communicating with their bank and seeing what that direct deposit is. There's no more need to request income documentations because we can get that information. So that makes it easier for you as an agent or the loan officer you're working with to not have to be chasing them down for updated documents or trying to get those documents. We can pull those documents through the web now. So that allows for a faster close and a better borrower experience. We know that when you're working with loan officers, a lot of times the reason you choose the particular loan officer you're working with is because of the experience that they provide to your customer. You want your customer to have the best experience, and through innovation like AIM, it allows them to have a much more better borrower experience because they don't have to be providing documents. And sometimes they'll email those documents unsecured, and that creates potential for fraud, or they'll fax those documents in, but they don't have a fax machine and they got to go somewhere to send those in. Believe it or not, people are still using fax machines. So again, innovation like AIM allows us to make that process a lot more seamless and a much better experience for your customer. So we know that self-employed borrowers are becoming more and more. You've probably heard the term, the gig economy. Those folks who are self-employed working for Uber, Lyft, Uber Eats, Grubhub, and so on and so forth. So they're self-employed, and whether that's their primary source of income or whether that's a secondary job, they are self-employed, and it can be very difficult for loan officers and underwriters to help determine what that real income is based on their tax returns. So we have a great innovation to a third party that we're working with LoanBeam. And so what LoanBeam does is it uses optical character recognition to read the tax returns and then it uses technology to determine what their actual income is. And then that income determination that it came up with is repped and warranted, meaning it's not holding the loan officer responsible for that calculation. LoanBeam came up with the calculation. They're highly confident that that calculation is accurate. And so again, it makes it much more seamless, much easier for your customer, for your borrower to be able to have a transaction, to come up with a, a pile of tax returns. Sometimes they're 20, 30, 40 pages thick. And instead of having that loan officer have to go through it and interpret it, they just scan it, LoanBeam reads it, and comes up with a very highly accurate loan or income calculation. Again, making it just much better experience for your customer. Today's appraisal. So appraisal pain points, and I'm sure many of you have experienced this. There's a shortage of appraisers and few new entrants into the profession, so it's going to get worse as far as appraiser availability. Costs have increased from to $700 to $900 in many markets, and then the completion can take as long as 6 weeks. And I, at one point, was a real estate agent as well. And I know that stress of just waiting to find out, is it going to come in at price? What are we going to do if it doesn't come in at price? Coming up with contingencies. Through our ACE, automated collateral evaluation, our systems use technology, use available information that's out there to come up with a reliable and accurate estimation or evaluation of what that property is worth. And that's done almost instantly once the loan officer runs runs the loan through our LPA desktop or LPA underwriting system. It will come up with a automated collateral evaluation. So you'll skip the appraisal fee altogether, saving your borrower, again, anywhere from $700 to $900 in many cases. And again, improve the lending process. It'll make it much more efficient. So you don't have to worry about, is it going to come in at price? In many cases, you don't have to worry about the appraisal contingency. So that helps you submit a much stronger offer if you're not worried about, is it going to come in at price? You can remove that appraisal contingency. You already know you're good on price. And so again, it just a much more seamless and easy execution, not only for you and the loan officer, but especially for that borrower, for your customer. And we use repeat data sales, prior appraisal data, public records, multiple listing service data, and proprietary information to come up with that valuation. So it's, again, we consider it to be very highly accurate, very highly reliable. And again, we rep and warrant that so that the lender is basically off the hook for that valuation. There's less chance for fraud. There's less chance for discrimination in that appraisal report. So again, overall, just a much better experience for everyone around. So supporting your business with Freddie Mac resources, more information on Loan Advisor and technology solutions. If you want more information on our Loan Advisor suite, you can go to freddiemac.com/loan advisor to sign up for updates. Our CreditSmart financial education curriculum. So this has been around for many years. It's a fantastic financial literacy curriculum that, again, as I mentioned before, helps prepare your borrower. Now, this particular one is a lot more broad. So it features topics such as credit, money management, home ownership, foreclosure avoidance, and more. It's free online on a flexible interactive platform. It's available in multiple languages. It's available through webinars, and it's also available in person. So one thing to consider is you can actually become a CreditSmart certified trainer. We have a training curriculum that would allow you to become a certified trainer, and then you can offer this class. And that allows you to not only be seen in the community as an expert in the community, you're providing value, but also it could potentially, lead to additional business. So that's our CreditSmart curriculum. And then we have our Homebuyer U, which is a part of the CreditSmart curriculum this particular portion is what meets our home buyer education requirements. So on some of the products that I mentioned, like HFA Advantage, like Home Possible or Home One, it may require home buyer education. And through our CreditSmart Home Buyer you will receive that home buyer education for your borrower. Again, it's absolutely free. It's available online. And, we believe and we know actually through data that it will create more sustainable homeowners. Your homeowner will perform much better if they receive that homebuyer curriculum versus those who don't. We have a real estate professional resource center. It's an online resource center to help real estate professionals grow their business with first-time home buyers, low to moderate income buyers, and within growing diverse communities. Learn industry trends, inform on key topics that drive business and empower their clients. Now, one thing I'll mention, and I think we're right around time here. We just have one more slide to go. But one thing I'll mention about this is, we know that, doing videos, whether you're doing them on Facebook, Instagram, Snapchat, or any of the other social medias, is a great opportunity for you to stay in front of your customers. But one of the challenges that folks have, that real estate professionals have and loan officers have, is coming up with content. Well, I want to make a video, but what am I going to talk about? Through our Real Estate Professional Resource Center, through the industry trends and the insights that we have available, you could literally come up with a video every single day on just one of the topics that we have here. There's hundreds, if not thousands of topics available, insights for you to be able to read and then do a quick 1-minute video on what you read. And if you want more information, reach out to me. So it's a great way to be able to provide you with insights that you can then share with your customers and stay in front of your customers and establish yourself as a local market expert. And along there, we also have customized templates to allow you to grow your business. And that's just, again, once you register, you'll have access to all of this information. Our subscription center received the latest news and updates. Again, by clicking on the link, and you'll all get a copy of this presentation, but by clicking on that link, you'll be able to subscribe. We're not going to spam you. We're only going to provide you with the information that you request. So it's going to give you a bunch of check boxes, tell us what you want to know, and we'll only send you that information. So with that, we wrap things up. I invite you to go all in with us, to partner with us, to make home possible for more of your customers, for more of the folks out there, to help dispel that 20% down payment myth that's out there. And with that, I'll stop and thank you for your time and see if we have time for any questions. So Tatiana, are you
yes.
Are you there?
So
do we have time for questions?
for some questions. So it looks like we only